When people think about property markets, they usually focus on things like interest rates or house prices, but the housing market is rarely driven by just one factor. And right now, several different drivers are influencing the market at the same time. One of those drivers making headlines right now is oil. So how did global energy prices end up influencing whether homes get built and how the property market moves here in New Zealand? At first glance, the connection may seem strange. Oil markets are global, property markets though are local. But energy prices ripple through the economy, and those ripples eventually reach the housing market. It starts with transport. When oil prices rise, petrol and freight costs tend to rise with them. Businesses pay more to move goods around the country, and those costs slowly filter into everyday life. Fuel prices increase, deliveries become more expensive, groceries creep up. When that happens, household budgets begin to tighten. And when household budgets tighten, people naturally become more cautious, about those large financial commitments like buying a property. Another driver comes through interest rates. When costs begin rising across many parts of the country, attention quickly turns to inflation and the outlook for interest rates. Mortgage rates follow interest rates. So when interest rate expectations change, borrowing conditions change as well. And those conditions shape one of the most important mechanisms in the property market, borrowing power. When borrowing power tightens, fewer buyers can enter the property market, but borrowing conditions are still only part of the picture. Another driver influencing the property market right now is construction. Building homes relies on materials moving through global supply chains. Timber, steel, fittings, equipment all depend on shipping, freight and transport. And when oil prices rise, moving those materials becomes more expensive. And when building costs increase, some development projects stop making financial sense. And when fewer projects move forward, fewer homes are built. For developers, even small cost increases can determine whether a project moves forward or simply stays on the drawing board. When that pipeline slows down, fewer homes enter the market in the years ahead. And when population continues growing at the same time, pressure can gradually build in the housing market. Another driver influencing the market this year is policy. This election year is bringing tax policy back into the property conversation. Labor's proposed introducing a capital gains tax on investment in commercial property. Investors often will reassess decisions before legislation becomes reality. Some delay purchases, others become more selective, and some move earlier before potential rules change. Therefore, today's city planning discussions may quietly influence tomorrow's price dynamics. Planning rules define how much housing can realistically be built in a city, and if the planning envelope narrows, supply flexibility narrows with it. And in growing cities, limited supply flexibility can gradually rebuild pressure in the housing market over time. So, to recap, the property market right now is not being driven by one single force. Several drivers are operating at the same time, like energy costs influencing household budgets, interest rate expectations shaping borrowing conditions, construction costs influencing housing supply, tax policy uncertainty influencing investor behaviour, and planning rules shaping the long-term housing pipeline. For investors and homeowners trying to understand the market, it can help to watch the drivers rather than just the headlines. Things like oil and petrol prices, signals from the Reserve Bank when they make their announcements, freight and construction costs, election year tax debates, and planning rules that shape future supply. By the time those drivers show up clearly in house prices, they have usually been influencing the market quietly for months or longer, which is why understanding the forces behind the market often matters more than reacting to the latest property headlines. You can read our detailed report on our website. The link is in the description. Hey there, if you enjoyed the content today and you'd like to stay up to date with the latest property market research, click the subscribe button.